So I think it's the beginning of the end, right? I mean, you have FTX hammering the market, but I think one of the important things to take away from FTX and the collapse is that if you look at the Terra Luna collapse that caused, or that Bitcoin took a hit on, Bitcoin dropped 45%. The FTX collapse, which was much bigger in terms of an earthquake for the crypto sector, you only dropped 25%. So what this is a market that still probably has some flushing out to go, but it is getting close. There's no doubt about it that we're getting close to it. We're also getting closer to potential regulation, which I think will be a huge asset for Bitcoin and cryptocurrencies, at least the Bitcoin and cryptocurrencies that are strong out there, as I do think that that will be a avenue for big money to start to dabble in crypto again.
While Garrett's long-term outlook on Bitcoin is optimistic, his chart suggests that the cryptocurrency could drop as low as $9,000 in the near future. Nevertheless, Garrett intends to dollar average and keeps buying more Bitcoin when the price drops. He anticipates a future price surge and wants it to be in the best possible position to take advantage of it. In a recent interview, Garrett drew parallels between the cryptocurrency industry's recent events and the 2008 financial catastrophe on Wall Street. He specifically mentioned the fall of FTX. He said that Bitcoin, like equities, might take another 6 months after such an incident to hit its bottom. Inflation peaked in 2022 at 9.1%, and the Federal Reserve is still raising interest rates to combat this. Soloway predicted that inflation would remain elevated in the year 2023. Listen carefully as the video progresses to get Soloway's insights on Bitcoin, the macroeconomic outlook, Fed rises, and the direction gold is taking.
Absolutely. So I'm still looking at potentially 12 to 13,000 is a short-term target. I do believe it'll go lower than that and probably pierce 10,000 and could get as low as 9,000 before this is all over. So again, if you look at it, and there's a couple ways. You could look at it the half full, the glass is half full, which is the negative, which is, oh my goodness, it could still go down 30, 40% more. Or you could look at it half full, which is basically saying Bitcoin's dropped from 69,000 to 16 and change here. Worst case, it's got another 7,000 and change to go, and then we can start to think about really picking some up heavily and looking for some major upside.
What about in the next couple of days? Are the charts pointing to any momentum in either direction for the next couple of days? Like you said, it's kind of choppy sideways.
I'm a buyer of Bitcoin, but again, it's a swing trade for me, looking for a move up here in the short term. But just understand, everyone out there understand that I'm not looking, this isn't a long-term trade. It's looking for a pop in the near term, the next 2 to 3 days, weeks, whatever it may be. And then once we get up, if we get up to about 18.5, I'll pare it back, take some profits, and then potentially just stay on the sidelines until I think there's a better entry.
All right, let's talk about the Fed now. Minutes came out earlier this week, and they basically announced that they would keep policy rates restrictive until inflation is no longer unacceptably high, were the words of the Federal Reserve governors. Let's pair that with the other economic data that came out this week, which is the ADP report. Jobs numbers came out. Initial claims were lower than expected, and the jobs payroll numbers were higher than expected, meaning the economy from an employment standpoint seems to be doing better than consensus expectations. Ironically, when that data came out a couple of days ago, I believe it was 2 days ago, the markets actually tanked. So let's describe what happened this week with the stock markets in relation to the Fed, in relation to employment.
Yeah, so you're right. Private sector jobs numbers came out much better than expected. We know that the Federal Reserve released their minutes earlier this week and basically said don't expect any rate cuts in 2023. And the markets didn't like that. The markets, again, this is hawkish talk. This is hawkish economic data on jobs. The key today, and this is why the markets rallied back on the non-farm payrolls number, they basically were thrown a bone in that wage growth has slowed. So again, who would have thought that saying, oh, people are not making as much money, or the amount that they're making in percentage terms is coming down a little bit. But that was the first sign that maybe there's some weakening in the labor market, and the market's just ripped higher on that. Now, I will say this, is that ultimately the market is going to like weak data, until we get to a point where we see a recession, And then when the Fed does not come to the rescue, the markets will freak out. And that's my base case for this year. I think by the second to third quarter, we see ourselves in a recession. The market and investors will say, hey, Federal Reserve, we're in a recession. Can you start cutting rates? The Fed is going to say, nope, we can't do it yet because inflation is too high. We don't want to see a repeat of the 1970s where they cut rates too early and then inflation surged back.
Okay, so based on what you've just said, that I'm guessing that you are still maintaining a somewhat cautious, if not outright bearish stance in the markets, because basically if the Federal Reserve remains restrictive, we're not going to get a reprieve from tightening monetary policy, right?
No. Yeah, there's no reprieve for at least this year. The only way we get a reprieve is, number one, if inflation miraculously goes back below 2% and then the economy weakens, or if the economy weakens so dramatically that we see like 10% unemployment, then I think the Fed might be forced into stimulating things at that point. But right now, the Fed... Yep.
What if they don't raise rates anymore? I mean, restrictive could just mean they can keep rates at an elevated level without bringing it down. What if they don't raise rates anymore and just don't touch it? Would that still be bearish?
Well, you're going to get the short-term relief rally, right? So right now the markets are pricing in at least a 25 basis point rate hike coming up, maybe at least a couple more this year. I don't think there's much to go, maybe a little bit above 5% on the Fed funds rate. But the bottom line is at the point where they say, hey, we are done raising, we're going to go into a pause mode, the markets will see a very short-term pop. But again, it's going to be short term because as economic data starts to get weaker and weaker, and it is, I mean, you can see, again, more layoffs every single day. Amazon just announced that they were going to lay off even more people. So it is coming. The wave of a recession is on the horizon, and it is going to smoke the US here. And when we get into that point, the Fed is not going to be cutting rates right away, and the market is going to throw a big fit. We are coming into some resistance on gold, so you might get a little bit of a pullback. You can see that this choppy consolidation level, that's where we are. So look for a near-term pullback of sorts, but I do think that gold is going to head sharply higher. I'm going to show you this parallel channel. It's one of my favorite parallel channels here. And again, basically what we can do here is stretch this down. This is what we would call a bullish consolidation multi-year period on gold. And what this tells us is that at some point we are going to blast through the upper end of this and we are going to be off to the races, a la 1975 to 1978. If you go back then, the same exact pattern played out. You had 2 years up here, just like we did in 2018 to 2020. You had 2+ years of choppy sideways action, and then gold literally went from about $100 an ounce back then to $1,000 or $900 an ounce. And again, I'm not calling for a 9 or 10x on gold here. I think I'd be very happy with a 2 to 3 times X on gold. So, for me, this is the play right now. I think next year in 2024, very likely Bitcoin could be the best performer, but gold again is the safest, best bet here for 2023.
Though Soloway had previously said that the stock market is not in a bear market and would not be for at least another 10 to 15 years, he has now implied that there are possibilities to profit in bad markets. He claims there will be gold in some locations if you travel in 2023. In terms of returns, gold is a fantastic investment. According to him, 2023 is all about gold. Even though Bitcoin will have a stronger year ahead, gold is still the superior and more secure investment. Long-term investors haven't fared well since the Fed started bailing out the markets, but he said that bear markets offer sufficient opportunity for swing traders. A trader's market where you can't just purchase and store for the next 2 decades is emerging, he said. You intend to cash out your gains quickly in preparation for future investment in another set of digital currencies when their value inevitably drops. DCG, 2 huge losses hit Barry Silbert's massive crypto consortium. On Thursday, troubled cryptocurrency leader Genesis said it would lay off another 30% of its staff and shut down its HQ Wealth Management division. According to the DCG website, HQ was the membership platform for digital asset entrepreneurs and investors to manage their lives and money. On Thursday afternoon, DCG's crypto lending platform, Genesis Global Trading, announced that 30% of its remaining staff, or 60 people, would be let go. This is the second round of layoffs at Genesis, which cut its workforce by 20 people 6 months ago. And that's it for today's episode. If you want more videos like this, keep in touch with us. If you like what you saw, I'd greatly appreciate it if you click the like button, share this video, and subscribe to the channel.